This is Nightly Business Report with Sue Herrera and Bill Griffith.
Dizzying day. Stocks rally, then fizzle, then gain steam again, making it tough for investors to figure out what exactly this market wants. Sour sentiment. Surveys show confidence in the economy is waning. The question is, when will the harder statistical reports show the same? Industry blossoms. Why Kentucky could fast become America's hemp capital. Those stories and much more tonight on Nightly Business Report for this Tuesday, December 18th. Good evening, everyone, and welcome. Bill Griffith is off tonight. Stocks struggled to keep a strong rebound alive in what was yet another volatile trading session. The market rallied early on, but midday the gains fizzled and then gathered steam again into the close. Energy stocks fell on a sharp decline in oil, but investors were mostly in wait-and-see mode ahead of the Fed's decision on interest rates tomorrow. The Dow Jones Industrial Average rose 82 points to 23,675. The Nasdaq added 30, and the S&P 500 was up a fraction. Bob Pisani takes a look at what's driving this market.
Stocks staged a comeback early on, regaining a big chunk of Monday's steep losses, but it was another rally that faded into the close. It's tough to figure out what exactly the markets want right now. So the market's been seized up by the slowing global growth story. And there's been a bit of a buyer strike lately. We've seen half-hearted attempts to rally in heavily oversold groups like banks, but all the rallies have failed. There's no real follow-through. No one's being rewarded for buying on the dips. The bulls are pinning their hopes on the Federal Reserve, putting a floor under stocks. Now, how would they do that? By signaling at most one rate hike next year, down from about the 3 rate hikes that were expected just a few months ago. But will it matter? The bears are screaming that the market has already priced in just 1 rate hike for 2019. And a bigger debate has emerged around those who are calling for the Fed not to hike at all tomorrow or even next year. The problem is that would imply the Fed is spooked about something in the economy that's causing them to hesitate. And maybe the markets will have the opposite reaction. They'll go down. So far, no real agreement on what would make the market go up or down on the Fed decision. Now, does the market rally because it's relieved, or do stocks sell off because investors think the Fed has panicked? You see, a lot of confusion. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And it has been a while since a Fed meeting has gotten this much attention. Today, policymakers gathered for the first of a 2-day meeting to decide on the direction of interest rates. Now, a lot has changed in the market in the past few weeks. And as Steve Leisman reports, the outlook is shifting as well.
It's become the most controversial Fed meeting in recent memory, with the Fed gathering with a prior forecast to hike rates, but after a deep market sell-off and worries about the economic outlook suggesting the Fed may have already hiked too much. Despite these concerns, 98% of respondents to the CNBC Fed survey think the Fed will still hike rates by a quarter point, but they've backed off their outlook for rate hikes in 2019, at least somewhat. The 43 respondents, who include fund managers, strategists, and economists, lowered their estimate for the number of hikes next year to just under 2. Before, the debate was whether there would be 2 or maybe as many as 3. The reason the group still thinks the Fed ought to hike is because they think the market has fallen too far. 63% say the recent market sell-off reflects too pessimistic an outlook for earnings and the economy. The biggest threats to growth are seen as protectionist trade policies, slowing global growth, and a Fed that makes a policy mistake. Amid those worries, respondents to the survey upped the probability of a recession the next year to 23%. That's the highest level for the Trump presidency and 4 points higher than the long-run average. But it surged before as high as 28% and not resulted in a downturn. So the Fed will have a choice to make, and the market bet is that it hikes rates now by a quarter point and holds off at least some next year. For Nightly Business Report, I'm Steve Leisman.
And it's no secret that the hot housing market is starting to cool. Today, another disappointing report was released, this time on home construction. Diana Olick is in Washington tonight.
The nation's home builders are pulling back. Single-family home construction took a dive in November, falling to the slowest pace in over a year, according to the census. And this came after another report that home builder sentiment had dropped to the lowest level in more than 3 years. The only bright spot in the numbers, multifamily starts jumped over 20% annually, showing still very strong demand for rental housing as existing home sales weaken further. New home sales for November are not out yet, but one top analyst who surveys over 400 builders says the writing is already on the wall.
I definitely think we're in a correction. Sales, according to us, our survey last month were down 19% year over year. Now that's off a tough comp. I would call that a correction.
Sales were high last year because mortgage rates were low, a full percentage point lower than they are today. Home prices are still quite high, although the gains are shrinking. While builders are now beginning to cut prices, they can't cut much, especially because they're largely building in the move-up market, not at the entry level.
Half of America can only afford a $230,000 mortgage, and the builders in good locations just can't get down to anywhere near that. 11 of the top 18 or top 19 builders, their average sales price is above $400,000.
Fewer people may want to move up now that mortgage rates are higher, because to move up, they'd have to give up the rock bottom rate they already have. For Nightly Business Report, I'm Diana Olick in Washington.
As Diana just mentioned, housing sentiment data has turned weaker. Other confidence surveys have also shown a dip, but that's just one view of the economy. The other is derived from harder statistical reports, which are yet to show substantial declines. Dominic Chu takes a look at the divergence.
Traders and investors are working their way through a confidence crunch. Markets have gone from an accentuate the positive, eliminate the negative mode to more of an accentuate the negative and eliminate the positive mode. The erosion in confidence is arguably being driven by trends in economic survey data that have been trending lower. For example, the CNBC Fed survey from today, nearly a quarter of respondents now expect a recession in the next 12 months. Or the Chief Executive Group's CEO Confidence Survey yesterday, which posted its sharpest month-over-month drop in outlook for business conditions this year and hit the lowest level since right before the 2016 presidential election. A big question for investors and maybe those on Main Street as well is when will the actual hard, albeit backward-looking economic data like gross domestic product, non-farm payrolls, consumer spending, and others start to reflect the more coincident and forward-looking sentiment indicators? Those who are already closely tied to the housing industry have been taking note for a while. This morning's housing starts data just the latest to show tangible and observable slowdowns that have been hinted at in housing sentiment data for months at this point. For now, hard economic data points are still supporting the thesis that the American economy is doing better than its peers around the world. Unemployment stands at multi-decade lows. The economy is not booming, but it's still growing. And many indicators for services and manufacturing activity still signal an expansion. Now the question is whether that hard economic data starts to catch up to these slowing confidence numbers or vice versa. For Nightly Business Report, I'm Dominic Chu.
The sell-off in oil deepened today. Prices touched their lowest levels since August of last year on speculation that Russia increased its output by a record amount this month. Concerns over global growth also raised doubts about future demand. Today, domestic crude settled 7% lower to $46 a barrel. Prices have now fallen about 38% since early October. To Capitol Hill now, where Senate Majority Leader Mitch McConnell is predicting there will not be a partial government shutdown, despite some back and forth between the two parties today. Funding for the government expires on Friday. Elon Mui is following the story for us tonight. Good to see you, Elon. So where do things stand, and are we any closer to reaching a deal?
Yeah, so the odds of a government shutdown have decreased dramatically today, and that's because, as you mentioned, Senate Majority Mitch McConnell has said that he is sure that lawmakers will be able to avert a government shutdown. Now, the current thinking is that they would be able to pass some sort of short-term spending deal, likely that lasts through February. Democrats have said that they would support such a deal. The big question is, will President Trump support it? He said, we'll see, when asked about this today around the White House. But certainly, Democrats and Republicans now are in agreement on what they want to see to move forward. President Trump just needs to get on board.
We'll see, indeed. Let's turn to next year, 2019. The Democrats will then control the House. So what are their plans for challenging the Republican tax law?
Well, one of the big criticisms that Democrats have of this law is that it primarily helps large corporations at the expense of workers. So not only are they upset about the decline in the corporate tax rate and that not turning into higher wages for workers, they're also unhappy with some of the provisions that lower the rate that companies pay on their foreign earnings. They're pointing to layoffs at places like GM and AT&T as proof that these companies aren't sharing the gains of the tax bill with their employees. You better believe that there's going to be plenty of hearings about this in the new year.
Oh, I'm sure there will be. And the ever popular, caps on state and local tax deductions, very unpopular in blue states.
Yeah, so one Democrat from New Jersey, Bill Pascrell, is right now preparing legislation that he plans to introduce in the new year that would get rid of this cap. And basically, this limits the deduction that households can take on their state and local property and income taxes to $10,000. That's hitting blue states like California, New York, and New Jersey really hard. A lot of Democrats in those states ran on that unhappiness over this cap. They won seats, they expanded their majority in the House, and now they're going to have to make good on some of those promises once they take control of the House in Congress.
There also was a move by the Treasury to take away the ability to kind of donate those property taxes to charities. Is there any movement, do you think, in the new year on maybe moving that back?
There had been a lot of consideration in some states about ways to work around this provision. I think that what you're going to see on Capitol Hill is Democrats trying to focus on getting rid of the cap altogether. The big challenge they face is that it's really expensive to do that. This is estimated to raise something like $830 billion over the next 10 years. So if Democrats have been hitting Republicans for the cost of their tax plan, adding another big tax cut is really not going to help with our debt and deficit situation.
It all means you're going to be very busy in the new year, Elon.
Absolutely.
Thanks so much. Elon Mui in Washington. It is time to take a look at some of today's upgrades and downgrades. Philip Morris was downgraded to underperform from neutral at Credit Suisse. The analyst says earnings growth will face some challenges. The price target is $74. The shares fell more than 7.5% to $75.17. Kansas City Southern was downgraded to neutral from overweight at J.P. Morgan. The analyst there cites heightened political uncertainty in Mexico. That rail operator gets half of its revenue from that country. The price target is $118. Shares fell a fraction to $95.65. That same J.P. Morgan analyst upgraded Norfolk Southern to overweight from neutral. The analyst sees about $600 million in potential productivity gains. The price target is $203. Shares were up slightly to $148.36. Still ahead, the sector that's outperforming the broader market for the first time since 2015. FedEx is cutting its earnings forecast for next year, citing weakness in Europe and signs that global trade is softening. The package delivery company earned $4.03 a share, which was above expectations. Revenue was up from last year and slightly better than estimates, but it was the outlook that investors focused on, sending the stock initially lower in after-hours trading. Eric Chemi has more on FedEx's quarter.
The big takeaway from FedEx today was the fact that the company lowered its earnings guidance for the rest of its 2019 fiscal year. The company said while the U.S. economy remains solid, its international business weakened during the quarter, especially in Europe. As a result, the company will be installing new cost-cutting initiatives to mitigate that softness. Some of that cost-cutting includes a buyout program for employees, cutting back on variable compensation, and limiting certain staff hiring. FedEx did say, though, that it is in the midst of another record holiday season. For Nightly Business Report, I'm Eric Chemi.
To China now, where that country's president talked up the Chinese economy. President Xi pledged to continue its path of reforms, which includes boosting private companies and strengthening state-owned enterprises. But he did not offer specifics on how to tackle China's weakening growth, rising debt, and the ongoing trade war with the U.S. The Chinese telecom giant Huawei is facing challenges around the globe. First, there's the arrest of the company's CFO in Vancouver that we've been telling you about. And now a number of key markets are either reviewing purchases of Huawei equipment or have ruled out using its 5G network products. And that has the company going on an all-out PR blitz. Eunice Yoon has more.
Chinese telecoms gear maker Huawei is on a global PR campaign to convince the world that its 5G technology can be trusted. Today, at its campus in southern China, one of Huawei's most senior executives held a rare 2-hour press briefing with foreign journalists. Rotating Chairman Ken Hu challenged international doubts led by the U.S. about the security of its products. He said, over the past 30 years, hundreds of telecom operators have used Huawei's products, and there have been no major cybersecurity incidents, and almost zero Huawei equipment has been used in the U.S. So where's the evidence to say Huawei is insecure? The Shenzhen-based company is now embroiled in the trade dispute between the U.S. and China after its CFO was detained in Canada at Washington's behest. Hu wouldn't comment on the CFO's case, but suggested that the international pushback against using Huawei gear is political. He pointed to strong sales as proof that customers are sticking by Huawei, saying it won 25 commercial 5G contracts and expects to rake in $100 billion in revenues this year. Today, the company opened certain research labs to the media for the first time, showcasing its latest technology, some which Hu estimates could be 12 to 18 months ahead of its rivals. Despite the PR effort, Huawei faces concerns that the Chinese government could make demands that the company wouldn't be able to refuse. Hu addressed that issue, reiterating that no law in China requires companies to install backdoors, and added, in the past, we have never received any such requests to provide information. In the future, we will also, in strict accordance with the law, deal with similar situations. For Nightly Business Report, I'm Eunice Yoon in Shenzhen.
Navistar keeps on trucking, and that's where we begin tonight's market focus. The truck maker topped Wall Street earnings and revenue estimates in the most recent quarter. The company says increased demand helped push up sales nearly 40%. The stock popped 15% to $27.57. Darden beat analyst earnings estimates by 1 penny. Same-store sales rose 2%, which was above expectations. And the restaurant chain raised its profit forecast for 2018. The shares rose 5% to $103.85. Rent-A-Center ended a $1.4 billion deal to be bought out by a private equity firm. This after the deadline to close that deal was not extended. The FTC had raised antitrust concerns about the deal. Shares of the small-cap company dropped 9% to $13.03. And Micron Tech reported revenue that was weaker than analysts had hoped for. The chipmaker says a supply glut pushed prices of its memory chips lower, and that sent the stock lower in initial after-hours trading. The stock rose slightly in the regular session to $34.11. Real estate investment trusts, otherwise known as REITs, are beating the broader stock market for the first time since 2015. The benchmark index for the sector has a total return of 2.6% compared to the 3% decline for the S&P 500. But will this trend continue? We are joined now by James Sullivan, REITs analyst at BTIG. James, nice to have you here. Welcome.
Good to see you, Sue.
You've picked roughly 3 sectors for us to take a look at, and a number of names in each one of them. We kind of broke it out into malls, apartments, and hotels. 'Tis the season to go shopping, so let's start with malls. You have 2 names you like there, Simon and Macerich.
Sure, that's right. We think the consumer is in good shape. We have very low unemployment. We have upward pressure on wages, and we have relatively high consumer confidence. We're seeing sales surprise to the upside in the holiday season so far. And we think that positions portfolios of A-mall REITs very well for 2019. So Simon, which is the largest REIT with a $55 billion market cap, great balance sheet, very well positioned to outperform for the next several quarters, we believe. And Macerich, which is focused in the West Coast primarily, a very strong portfolio. We also like how they're positioned. That stock has underperformed year to date, and we think that makes the value proposition especially attractive for Macerich.
Let's move to apartments. And you know, the recent housing data showed growth in apartment buildings, but not in single-family homes. So it seems to me as though the apartment builders, they have pricing power.
That's right. What has been bad for home builders has been relatively good for apartment owners. Lease turnover rates are down at all-time lows, i.e. renters are staying in apartments longer. That's allowing apartment owners to raise rents on new leases at a higher rate than many of us expected they could at this time versus our expectations at the beginning of the year. As we look out to 2019, even though we saw a sizable increase in starts and permits today, we think demand is going to be more than healthy enough to absorb that increase in supply that we're going to see. And there's very strong momentum in terms of top-line growth.
I just want to get to you have 3 picks, Avalon Bay Communities, Essex Property Trust, and Camden Property Trust. Which would be your favorite out of those names?
Well, I would say at this point probably Avalon Bay. They have a portfolio that's pretty much concentrated on the West Coast and the East Coast, so they will benefit from strong job growth in those major gateway centers. They're also a very successful developer, and we like their ability to create value through their development.
Okay, let's move on to hotels in the 30 seconds that we have left. You like Host Hotels and Pebblebrook Hotels. Why?
Yes, Host is the larger cap name. It has sold off, in fact, with concern about growth in the economy next year. We think it's very attractively priced, well below its 12-month high. And Pebblebrook is a smaller cap name, very well positioned to benefit, especially with a focus on the San Francisco market, which should do very well as the Moscone Center comes on stream in the coming quarters.
All right, James, thanks so much for those picks. We'll see you again soon.
Thank you.
James Sullivan with BTIG. Coming up, Kentucky's big bet on a growth industry.
Here in Kentucky, they have high hopes for this plant, but it's hemp, not cannabis. Coming up, I'll explain how President Trump could turn this into a cash crop. I'm Frank Holland. I'll have that story coming up on Nightly Business Report.
Here's a look at what to watch for tomorrow. As we reported, the Federal Reserve will issue its decision on interest rates at the end of one of its most controversial meetings in recent memory. Existing home sales for November are due, and this report follows a string of weaker reads on housing. And weekly mortgage applications will tell us if the recent dip in rates led to more buying or refinancings. That's what to watch for on Wednesday. The move towards gender equality has stalled. According to the World Economic Forum, fewer women are joining the workforce, and up-and-coming industries like artificial intelligence are dominated by men. Women did make gains in income over the past year, but saw declines in access to health care, education, and political involvement. SpaceX is reportedly raising $500 million in its latest fundraising round. According to the Wall Street Journal, that puts the space venture's valuation at more than $30 billion. The company, founded by Elon Musk, will reportedly use the new cash for a satellite internet project. The Surgeon General issued a rare advisory about e-cigarettes. He is pushing for things like new taxes and indoor vaping bans to combat teen use, which he calls an epidemic.
We know that nicotine exposure during adolescence can uniquely harm the developing adolescent brain, impacting learning, memory, and attention. We know that exposure during this critical brain period can lead to further addictions.
Just yesterday, a new report showed that more than 20% of high school seniors say they vaped a nicotine product within the past 30 days. That's about double the number from a year ago. Cannabis company Tilray inked a global supply and distribution agreement with Novartis. Tilray calls the tie-up the first deal of its kind with a big pharma company. That sent shares of Tilray higher by 16%. One variety of the cannabis plant is hemp. When the president signs the Farm Bill, hemp will become legal in the U.S., and Kentucky could be center for this new budding industry. Frank Holland is in Lexington for us tonight.
These are hemp flowers, the raw material for cannabidiol, better known as CBD, which is being touted as a treatment for a number of conditions. It is a budding business that generated $590 million in U.S. sales this year and is projected to blossom into a $22 billion industry by 2022.
We already know that the demand is there for the CBD. Basically, this market is exploding, and it will be growing astronomically or just geometrically in the next 2 or 3 years.
Bill Hilliard is the CEO of Italo Holdings, a company that is banking that hemp will replace tobacco as the cash crop of Kentucky. It depends on President Trump signing the Farm Bill, making it federally legal.
Profit margins are, on an average hemp crop, it far exceeds an excellent tobacco crop.
Growing hemp for Brent Cornett and other farmers in the Bluegrass State has been legal since 2013 under a state program. Hemp is a plant similar to marijuana, but it doesn't get you high.
Our growers will tell you that they can make the same amount of money with an average hemp crop as they used to be able to make with a successful tobacco crop.
Here at Italo's warehouse, they have enough seed to make about $250 million worth of CBD, but the company is also exploring other commercial uses for hemp.
The floral material can be used for CBD and some of the cannabinoids. The grain or the seed can be used for the superfoods, high protein powders and the hemp seed oil. And then the stalk can be used for building materials.
The plant already has a wide range of consumer uses with Estee Lauder, Home Depot, and GNC putting it into products.
The fact that we've got a crop that can benefit people and still make a living from is just really exciting.
For Nightly Business Report, I'm Frank Holland in Lexington, Kentucky.
And that'll do it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us. Have a great evening. We'll see you tomorrow.